Hi students, good evening again. In the previous lectures, we were discussing about the limited liability company, and we have discussed about what is the concept of the authorized share capital, what is the concept of the issued and the paid up capital, initial public offering. So how the new company is set up, the promoters are there, they are starting a new business, they are starting a new company, so they have to register the company, they have to register the share capital, and after that they will give the offer to the general public. They can buy the share, so the par value is there. So for every share there is some specific value. It can be 1 real, 2 real, $1, $2, 1 rupee, 2 rupee, $100, 100 rupees. So it depends on the country and the value what they are offering. So we assume that the company has a total authorized capital of how much? 100,000 shares, and the authorized capital value is 1 million. Why? Because the par value per share is $10 and the company has issued almost 70,000 shares. So they have a 700,000 of the issued and the paid up capital. So today we will discuss some of the next things that is related to in the dividend. The dividend is what? Dividend is the distribution of the profit. So obviously the owners are investing in the business. Why? They want to get the profit, and how this profit is distributed among the shareholders? It is through the dividend. So the dividend has two different types. In the previous lectures we have even calculated how dividend is there, what is the value, how it is depending. So it can be a cash dividend or it can be a bonus share. What is the difference between that? The cash dividend means that every shareholder, we just say, for example, they have issued shares of 70,000 and they have a retained earning or unappropriated profit is available with them. So what they can do, they can decide that, let's say that $0.1 per share. And they decided that for every share they will give how much? A $0.1 as a dividend. So it means 70,000 shares are there, so it will be, so the total number of shares they have is the 70,000 shares, and they have decided that they will give a dividend of $0.1 per share. So it means the total dividend they will give in the form of the cash will be $7,000. So in this way they are giving the cash dividend. Sometimes the company has no cash available, or they don't want to give the cash to the shareholder or the cash dividend to the shareholder. So what they can do, they can give up shares to the existing shareholders. So that share in the form of the dividend is called as the bonus shares. But we have to consider this thing also, that is it available? Still the company can issue the shares or not. In that case, the company has a total 100,000 shares, that is authorized capital, and 70,000 shares they have already issued. It means the company has still a room. They can still issue how many shares? They can still issue 30,000 shares, because out of 100,000 still they have issued only 70,000 shares. So it means they can issue some more shares. So the bonus shares is what? Bonus share is the dividend that is given to the shareholder, but not in the form of the cash, but in the form of the new shares. So what they can do, they can say, like for example, 1 new share for every 10 shares. So it means the company will issue 1 new share to the person, to the owner, to the shareholder who has already how many? 10 shares. The person who has a 10 shares, he or she will get 1 more extra share. So that will be considered as what? The bonus share. So it means here out of 10 they will give, so how many new shares will be issued? So 7,000 new shares will be issued, because already they have a 70,000. So 70,000 multiplied by 10 divided by 100. So it will be, or 1 divided by 10. So it will be 7,000 new shares will be issued. So this 7,000 will be considered as what? As the bonus share, and obviously it is issued at the par value at the $10. So in this case they are giving a total dividend of $70,000. So $70,000 is what? That is the total issued shares in the form of the bonus shares. So this is again reduction from the retained earning, but not in the form of the cash. It is a reduction from the retained earning in the form of the new shares. Now company has already 70,000 shares, 7,000 shares more issued. So now total shares issued by the company is 77,000. So still company issue 23,000 shares because maximum limit for the share is 100,000. Now the next thing is related to the concept of the stock split. Stock split is what? Let's say the par value of the share is $10 and we just assume that the market value per share, the current market value is, let's say, $20 per share. Now the company want to distribute the number of shares. They want to increase the number of the shares. One share has a value, the par value of $10, but in the market it is selling for how much? It is selling for $20, and the total shares are how much? That is 70,000 total shares that are issued here. So they may distribute these shares. Obviously they have to change all the memorandum of association, articles, and all the structure of the company, the capital structure of the company. So they may split the shares. Like they can share one share into two shares. Means already if there is a one share, so it will be split into the two shares, and the par value that was what? That was at $10. So it will be 2, so it will be $5. So the $5 is the new par value, and the number of shares will be how much? It will be, instead of 70,000, the number of shares will be 70,000 multiplied by 2. Now the total 140,000 shares, and one share for how much? That is for $5. So the total capital, the amount will be 700,000. There will be no change in the amount of the share capital. Only what will change? The par value will change and the number of shares will change. But still, we have 140,000 shares, and one share for how much? That is for $5. So total amount will be how much? It will be still 700,000. Means there is no change in the total issued capital of the company. Only they have split. So what is stock split? They are issuing a share. Instead of one share, they are issuing two shares. Means they are not issuing new shares. They are just replacing one share. If the person has a one share, he or she will get two shares instead of the one share. So the one share will be cancelled with a par value of $10, and the new share, two shares will be issued to the same person with the par value of the 5. So in that case, the number of shares will increase. Then the shareholders will be same, the total share capital will be same. Only what will happen, the company has a more number of shares and the par value per share will also change. So it is splitting. So it may be like one share can be split into the 5 shares, it may be split into the 10 shares. So it depending on the company policy, but main concept is that they want to increase the number of shares, but with that increased number of shares, they will also decrease the value of the par value of the share. So in that case, the total share capital will be same. There will be no change in the total share capital. Only the number of shares and the par value per share will change. And obviously it is split, means more number of shares, but the par value per share will reduce. The next concept that we have is related to the shares type. We have normally two main share types. One is called as the common shares and the other is called as the preferred shares. Now we have a 2 or 3 or mainly like a 3 or 4 differences are there between the common shares and the preferred shares. So what are those differences? The first of all is the concept of the dividend. Now dividend was what? As we have discussed earlier, it is a profit which is distributed among the shareholders according to the agreed ratio. We have just assumed it can be in the form of the cash or it can be in the form of the bonus. Now in the ordinary shares or in the common shares, there is no fixed dividend. Means sometimes the company has a profit, they are giving the dividend. Sometimes company has a loss, they are not giving the dividend. Even sometimes company has a profit, but still they decide not to give the dividend. So there is no fixed dividend, so the dividend is variable. So variable means that will be depending on the profitability and the company policy, so the dividend will be variable. But in the preferred shares, the dividend will be normally fixed. So this can be in the amount, or it can be a value in the percentage, like a 10% of the par value or $1 per share. So it will be fixed. The next thing, that is the cumulative dividend. Cumulative dividend means what? Sometime company has to pay the dividend to the preferred shareholders because it is obligation, it is fixed, but they don't have a cash. So what they will do, they will pay the next year dividend, but it will not be dividend for 1 year, it will be dividend for the 2 years. So it will keep on accumulating. So in the preferred shareholders, we have a cumulative dividends, but when there is a common shares or the ordinary shares, there is no cumulative dividend. Means if this year you haven't paid the dividend, the company has not paid the dividend, so what will happen next year? They may pay, they may not pay, depending on the profitability company policy, but it is not an obligation that they will pay the dividend for this year and even for the previous year, because in the previous years they haven't paid. So here we have a cumulative dividend, but here there is no cumulative dividend. The next thing, that is the convertibility. Sometimes the preferred shares can be convertible to the common shares. Convertible means what? The person has a preferred shares. Now he or she, as an owner, as a shareholder, they want to convert their preferred shares into the ordinary shares, because the ordinary shares normally are getting more profit, more dividend, because it is not fixed. If the company is growing, the more profitability is there, the more dividends are paid to the, but they are getting the fixed dividends. So that's why there's a chances that sometimes they want to convert their preferred shares into the common shares. So they have an option that they can convert these preferred shares into the common shares. That is a convertible preferred stock. Now the next thing that we have is related to the liquidity. Liquidity means what? When there is a liquidation, when the company is into the liquidation process simply means that the company is going to be closed. Why it is closed? Because it may be sometime the condition is like bankruptcy is there, or there's a liquidation process is going on, or the insolvent company is there. So what they have to do? They have to sell all their assets and pay their liabilities, and even after that, if some cash or if some asset is left, it will be given first of all to the preferred shareholders, because they are the preferred shareholders, so it is their first preference. And anything left, that will be given to the common shareholders. So they have a first preference even at the time of the liquidation. Now, in this case, the company sometime is going to the liquidation, they are going into the insolvency, and they have to sell all the asset and they have to pay all their liabilities. And even after paying some liabilities, or all the liabilities, if something in the form of the cash or asset is left, it will be first paid to the preferred shareholders, and after that, if something is left, some cash or asset is left, that will be paid to the, or that will be distributed among the common shareholder. And the last thing that we have is the concept of the voting right. The common shareholders have a main thing, that is main part is what they have a voting right. But the preferred shareholders, they don't have a voting right, because all the privileges they have, they get the dividend first of all, they have a cumulative dividend, they have also the convertibility option. Even in the case of the liquidity, they have a first preference. But that common shareholders who are running the business, they are the voting right. They have a voting right. From that voting right, they can give the voting in the board of directors selection, or in the election of the board of directors, or even they can give their votes when there is a company policy decision, or when there is a annual general meeting, there is some resolution is passed. So they are asking, the board of director is asking to the general shareholders or the common shareholders, so they have a voting right. Means they can change the board of directors. If they have more right, they can make the company policy. So this is the main thing which they have, that is related to the common shareholders. So this is the main strength of the common shareholders. Other than that, the dividend which is normally fixed for the preferred shareholders, they have a cumulative dividend. Means this year if you are unable to pay, the company is unable to pay, they have to pay next year for 2 years. And if it is still not paid for the 3 years, they have to pay the dividend for the 3 years. Here also they have a convertibility. They can convert their preferred shares to the common shares if they think they have a more profitability. In case of liquidity, the first preference is given to them, but the problem is they don't have a voting right. So this voting right is the main, you can say, the strength of the common shareholders. And if the company is in the progress, there are more profitability there, so they are getting more dividends as compared to the fixed dividend which is given to the preferred shareholder. So today we have discussed some of the basic concepts like what is the stock split. The common shares are normally split into the shares like a 2 shares, or 1 share is split into the 5 shares or 10 shares depending on the company policy. The next thing that we have discussed, that what is the dividend. It can be a cash dividend or the bonus shares. And then we have discussed the ordinary shares capital and the preferred share capital, what is the main difference between them. So this is the concept, and this is the topic for today. But still, if you have any doubt, if you have any question, you can ask me in the comment section. Thank you very much.